Hello everyone. Today we're going to discuss a topic that's been buzzing in the financial world, the 2024 market reversal. This phrase may sound daunting, but fear not, we're here to demystify it. Our exploration will take us through understanding market reversals, their historical context, and the economic factors contributing to these changes. We'll also delve into strategic approaches to navigate this anticipated shift, offering insights into investment strategies, risk management, and more. So, buckle up as we dive into the exciting world of market reversals. Firstly, we need to understand what a market reversal is. It's a significant shift in the direction of a market's price trend. This can happen in any asset class, from stocks and bonds to commodities and currencies. Market reversals occur when the general consensus of value in the market changes, leading to a shift in the price trend. This shift could be triggered by various factors such as economic events, changes in investor sentiment, or even natural disasters. Looking ahead to 2024, experts are predicting a market reversal due to a combination of economic indicators. These include high inflation rates, rising interest rates, and a slowing global economy. It's also important to note that market reversals don't just happen overnight. They're usually preceded by a series of events or indicators that signal a potential shift in market direction. Now that we understand what a market reversal is, let's take a look at the history. History often repeats itself, especially in financial markets. Let's take a brief journey back in time. The economic landscape has seen numerous market reversals, from the Wall Street crash of 1929 to the dot-com bubble burst in 2000, and the Great Recession of 2008. These events, while devastating, have taught us valuable lessons. In each case, the market overheated, driven by speculation and excessive risk-taking, leading to a sharp downturn. However, those who were patient, diversified their investment portfolio, and didn't panic sell, often came out stronger in the long run. We've learned that market reversals, while challenging, can offer opportunities for those ready to seize them. It's about understanding the market dynamics, recognizing the signs of a reversal, and having a plan in place to weather the storm. These historical lessons give us a framework to navigate the upcoming reversal. In the face of a market reversal, having a solid investment strategy is key. Let's break down some of the most effective strategies you can employ. Firstly, consider your asset allocation. This is the process of dividing your investment portfolio among different asset categories such as stocks, bonds, and cash. The right mix for you will depend on your financial goals, risk tolerance, and investment horizon. In a market reversal, you might want to adjust your asset allocation to reduce exposure to more volatile assets. Next, let's talk about diversification. This is the practice of spreading your investments around so that your exposure to any one type of asset is limited. This strategy can help you mitigate risks and smooth out your investment returns. Remember, diversification is not just about investing in different assets, but also about investing in different sectors, regions, and companies. Risk management is another crucial component of your investment strategy. The goal here is not to avoid risk altogether, but to understand it and manage it effectively. This could mean setting stop-loss orders to limit potential losses, investing in safe haven assets during times of market uncertainty, or simply maintaining a long-term perspective and resisting the urge to make impulsive decisions based on short-term market fluctuations. Now let's move on to identifying opportunities. Even in a market reversal, there can be sectors or industries that outperform others. Historically, utilities and consumer staples have been seen as defensive sectors that can perform well during market downturns. On the other hand, technology and consumer discretionary sectors might be more vulnerable. By staying informed and conducting thorough research, you can identify potential opportunities in various sectors. Remember, a well-planned strategy can help you weather any market condition. Whether it's adjusting your asset allocation, diversifying your portfolio, managing your risks, or identifying new opportunities, each of these strategies can play a vital role in helping you navigate a market reversal. And as always, it's important to stay informed, stay patient, and stay focused on your long-term financial goals. Risk management is crucial in volatile markets. This isn't just a catchy phrase, but a fundamental principle in navigating financial turbulence, especially during a market reversal. How, then, can we manage risk effectively? Firstly, it's essential to have a clear understanding of your risk tolerance. This is the degree of variability in investment returns that an investor is willing to withstand. It's influenced by factors such as your financial goals, age, income, and personal comfort with risk. Knowing your risk tolerance will guide you in making investment decisions that align with your financial objectives and comfort level. Secondly, it's important to diversify your portfolio. This means spreading your investments across a variety of asset classes to reduce exposure to any single investment or risk. Remember the old adage, don't put all your eggs in one basket? It's golden advice in the world of investing. Thirdly, consider hedging strategies. These are techniques that offset the potential loss from one investment by making another investment. It's like buying insurance for your portfolio. While it may not completely eliminate the risk, it can certainly mitigate it. Now let's shift gears and talk about alternative investments. These are investments that fall outside the traditional categories of stocks, bonds, and cash. They include assets like real estate, commodities, and cryptocurrencies. Real estate, for instance, is often viewed as a hedge against inflation. Its value tends to go up over time, providing a steady stream of income through rent. Commodities like gold and silver have historically been safe havens during times of economic uncertainty. They provide a tangible asset that retains value, even when markets are in turmoil. Cryptocurrencies, on the other hand, are a relatively new player in the investment field. They offer potential for high returns, but come with a high level of risk due to their volatile nature. It's advisable to approach them with caution and invest only what you can afford to lose. Diversifying your investments can offer a safety net during market fluctuations. By incorporating risk management techniques and considering alternative investments, you can better navigate the choppy waters of a market reversal. Balancing long-term and short-term investments is an art. First, let's discuss long-term investments. These are typically held for several years or even decades, providing the potential for gradual yet significant growth. They're often lower risk as they can weather short-term market fluctuations. Think of them like a slow-cooked meal. It takes time, but the results can be delectably rewarding. Examples include index funds, blue-chip stocks, or real estate. On the other hand, short-term investments usually span a few months to a few years. These can offer higher returns, but they come with higher risk. Picture them as a sprint. It's fast, intense, and requires careful strategy. Day trading stocks, options, and forex are some examples. So, what's the catch? Well, long-term investments require patience and a tolerance for riding out market downturns. They might also tie up your capital for extended periods. Short-term investments, meanwhile, demand a lot of time, knowledge, and nerves of steel to navigate volatile markets. But don't fret, you don't have to pick a side. It's all about balance. A well-diversified portfolio can include both long-term and short-term investments, catering to your financial goals, risk tolerance, and investment timeline. Consider this: long-term investments for your retirement fund, short-term investments for an upcoming large purchase. This way, you're not putting all your eggs in one basket. Striking a balance between these two strategies can help you optimize your returns. So start weighing your options, and let the balancing act begin. As we wrap up, remember that market reversals are a normal part of the economic cycle. It's not about panic, it's about preparation. We've delved into understanding market reversals and the indicators hinting at the potential shift in 2024. We've looked back at history, learning from past market cycles and their impacts. We've explored the significant economic factors and global events that could influence this reversal. Our journey took us through tailored investment strategies, identifying opportunities, and the crucial role of risk management. We've weighed the balance between long-term and short-term investments, and even ventured into alternative investment avenues like cryptocurrencies and commodities. But remember, knowledge is power. Continue to conduct your own research, stay informed about international developments, and seek professional advice. Your financial decisions should be made with careful consideration of your individual circumstances and risk tolerance. Stay informed, stay prepared, and you'll be equipped to navigate the 2024 market reversal successfully.